At 9:31 a.m., nothing looks wrong. Markets are open, screens are green, coffee is still hot. And yet, at that exact moment, thousands of people are making the same decision. Let's just be safe. Sell a little, move to cash, wait things out. Individually, it's rational. Collectively, it's a problem. Because in finance, the moment everyone tries to be safe, safety disappears. We like to think of markets as chaotic, millions of opinions, endless randomness, but under the surface, there's a strange pattern. People don't move independently, they move together, not because they're told to, but because they're reacting to the same signals at the same time. Rising interest rates, a bad earnings report, a headline that feels slightly off. Nothing catastrophic, just enough to trigger caution. And that's where it starts. Let's simplify this. Imagine a crowded theater. Someone smells smoke. They don't panic, they just stand up. A few others notice, they stand up too. Still calm, still rational. But now visibility drops. People can't see clearly, so more people stand. Then someone moves toward the exit, then another. And suddenly everyone is trying to leave at once. Not because they're irrational, but because they're reacting to each other. That's the financial system. Now translate that into markets. When uncertainty rises, investors do something very predictable. They reduce risk. They sell volatile assets. They move to cash or safe assets like government bonds. Again, individually, this makes perfect sense. If things get worse, you're protected. But here's the catch. Prices in markets are not fixed. They depend on buyers and sellers. And when everyone becomes a seller at the same time, prices don't gently decline. They drop fast. Let's say a stock is worth $100. A few people sell. It dips to $98. No big deal. But then more people notice the drop. They think something's wrong, so they sell too. Now it's $95. Then algorithms kick in. Automatic systems designed to reduce risk when volatility rises. They don't hesitate, they just execute. Sell orders stack. Liquidity disappears. Now it's $90. And suddenly what started as being safe is creating the very danger people were trying to avoid. This is where things get uncomfortable, because the system doesn't just reflect fear, it amplifies it. There's a concept in finance called liquidity. It's a simple idea. How easy is it to buy or sell something without affecting its price? In calm markets, liquidity is everywhere. You can sell and someone will buy. Prices barely move. But in stressed markets, liquidity vanishes. Buyers step back. They wait, because why catch a falling knife? So when sellers show up, there's no one on the other side. Prices gap down, not gradually, but violently. Now layer in leverage, because most large investors aren't just using their own money, they borrow to amplify returns, which works beautifully until it doesn't. When prices fall, lenders get nervous. They issue margin calls. Either add more money or we sell your assets. So investors are forced to sell, not because they want to, but because they have to, which pushes prices down further, which triggers more margin calls, which forces more selling. And just like that, the system turns into a loop, a self-reinforcing spiral. Here's the irony. The safer everyone tries to be, the more fragile the system becomes. Because safety in markets is not just about what you own, it's about what everyone else is doing. If you're the only one selling, you're fine. If everyone is selling, there is no safety. We've seen this before. In 2008, institutions thought they were managing risk, diversifying, hedging, following models. But those models assumed something dangerous, that not everyone would act the same way at the same time. They were wrong. When fear hit, correlations went to 1. Everything moved together. Assets that were supposed to protect portfolios fell alongside everything else, because the real risk wasn't in the assets, it was in the behavior. And it's not just big crises. This dynamic shows up in smaller ways all the time. A sudden market drop, a flash crash, a liquidity shock in a niche corner of the market. Each time, the story is similar. Too many people trying to do the same safe thing at once. Now add modern technology. Markets today are faster than ever. Algorithms react in milliseconds. Risk models update in real time. News spreads instantly, which means the gap between something feels off and everyone is selling is shrinking. What used to take days now takes minutes, sometimes seconds. And then there's passive investing, index funds. On the surface, they're the ultimate safe strategy, low cost, diversified, long term. But they also introduce a subtle shift. They don't analyze individual assets, they just follow flows. Money in, prices up. Money out, prices down. So when investors pull money out of the market broadly, everything gets sold. Good companies, bad companies, it doesn't matter. Because the system isn't asking questions, it's just executing. So you end up with a strange situation. The more people adopt safe, systematic strategies, the more synchronized the system becomes. And synchronization in finance is dangerous because it removes the buffer, the diversity of behavior that keeps markets stable. At this point, you might be wondering, why doesn't everyone just not panic? Why not stay calm, think long term? Because in real time, it doesn't feel like panic. It feels like responsibility. If you're managing money, your job is to avoid losses, not to philosophize about collective behavior. If prices are falling and everyone else is reducing risk, standing still doesn't feel brave, it feels reckless. So you act, just like everyone else. And that's the trap. The system rewards individual caution, but punishes collective caution. It's a coordination problem. No single decision is wrong, but together they create something unstable. Zoom out, and this becomes bigger than markets. Banks, funds, corporations, they're all connected through lending, through derivatives, through expectations. So when the system tightens, it doesn't stay contained. Credit becomes more expensive, loans get pulled, businesses slow down, hiring freezes. What started as a shift in investor behavior spills into the real economy. And yet, the narrative we tell ourselves is different. We say markets fall because of bad news, or weak fundamentals, or unexpected events. And sometimes that's true. But often, the real driver is simpler. Everyone tried to be safe at the same time. Which leads to an uncomfortable question. If safety depends on not moving with the crowd, and risk comes from doing exactly what everyone else is doing, then what does safe even mean? And more importantly, when the next moment comes, and it will anyone actually choose differently?